Students, I hope these videos are going to be very helpful in understanding some important concepts of macroeconomics. So now we would move on to chapter 3, that is methods of measuring national income. So after understanding various concepts associated with national income, we would today discuss how and by what methods we can estimate national income. So there are three different methods for measuring national income. Number one, value added or product method. At number two, we have income method. And number three is expenditure method. These three methods are used for calculation of national income in various economies. And now we are going to start with the first method, that is value addition method or product method. So this method is also known as industrial origin method or net output method. Now defining national income in terms of this method. So according to this method, national income can be calculated as sum total of value added by all the producing units in an economy in an accounting year. So that would give us the measure of value addition by all the producers in the economy, and therefore we would be able to calculate national income. Secondly, we may also work out national income by calculating the value of all final goods and services that are being produced in an economy in an accounting year. Now students, moving on to the procedure for working out national income through value added or product method, we would first try to understand what is the meaning of value addition. This value addition refers to the difference between value of output and intermediate consumption of a producer. Now the formula would become value added is equal to value of output minus intermediate consumption. So this is how we can work out value added by a producing unit in the economy. So it would be difference between value of output and intermediate consumption, as I already discussed. Now value of output. This value of output can be worked out by adding sales into change in stock. Now whenever a producer produces goods and services, his entire of his production may not be sold. So some part is regarded as sales while rest remains unsold stock, and this unsold stock is equal to change in stock. Now this value of sales can be calculated as price into quantity sold of a commodity, while change in stock can further be calculated by using the formula closing stock minus opening stock. Now this value of intermediate consumption can be defined as the value of intermediate goods or raw material used by the producer in the process of production. And now students, we would move on to an example in order to understand how we can calculate national income using product method or value addition method. Let us assume that a farmer buys inputs worth rupees 200, I mean seeds, fertilizers, etc., and converts those inputs into wheat worth rupees 600. That means these inputs are intermediate consumption for the farmer, while this wheat is the value of output. So value added by farmer would be value of output minus value of intermediate consumption, 600 minus 200. So that would give us value added by the farmer. So this I am writing in brackets is nothing but value added by the farmer, and this value added can be calculated by deducting value of intermediate goods, that is 200, out of value of output, that is value of wheat by the farmer, that is 600. So 600 minus 200 is 400. Similarly, this wheat worth rupees 600 is being sold to a flour mill, who further converts this wheat into flour worth rupees 800. So how much value added by the flour mill? 200 rupees. So this is value addition by the flour mill. Similarly, flour worth rupees 800 becomes intermediate good for the baker, who converts this flour into bread worth rupees 1000. Again 200 is the value added by the baker. 1000 minus 800. Now this bread, students, worth rupees 1000 is sold to the retailer. So this becomes intermediate consumption for the retailer, cost of raw material for the retailer who sells this bread to the customers for rupees 1500. So this bread worth rupees 1500 which is sold to the customers, to the consumers, is the value of final goods and services produced in the economy. Right? Now we would move on how we can calculate national income in this case. So national income can be calculated by sum total of value added by all the producers in the economy. Am I clear? So value added can be calculated as value of output minus intermediate consumption, and now you can add up the value of output by all the producers. You may see here value of output is 600, value of output is 800, value of output is 1000, value of output is 1500, and you would gradually deduct value of intermediate consumption. 200 for the farmers, then this 600 for the flour mill, this 800 for the baker, this 1000 for the retailer. So by working it all, computing value added, this would give us the extent of rupees 1300. If we add on value added by all the producers in the economy, which I have shown here in the brackets, 400 for the farmer, 200 for the flour mill, 200 for the baker, 500 for the retailer, what you will find is gross value added in the economy, total value addition in the economy, and that would be 800 and 5 1300. You would get the sum of value added as 1300, which would be equal to value addition in the economy. So students, sum of value added is called gross value added, that means total value added, and this is equal to GDP at MP. So sum of value added is equal to GVA at MP, gross value added at market price, which can be equated to GDP at MP, which is nothing but domestic income. Therefore, according to this method, sum of value added by all the producing units is equal to GDP at MP or so-called GVA at MP. And moreover, this can also be calculated as the value, market value of final goods and services produced in an economy in an accounting year. Here you may say, see, the value of final goods, that is bread, is equal to rupees 1500. So this is the value added or product method. And now we would discuss the precautions underlying it. First precaution is value of second hand goods. Sale and purchase of second hand goods is not included in national income. It is because second hand goods were produced back in some year, and in the estimation of national income in that year, their value was already being added. Now they are just like exchanged to somebody else. Therefore, the value of second hand goods is not included in national income of this year. It is because they are not simply produced in this year. Number 2, students, although value of second hand goods is not included, but commission on sale and purchase of second hand goods is definitely included in the value of national income. It is because commission is earned for the fresh services rendered to the buyers and sellers. Number 3, imputed value of production for self-consumption is included in national income. That means a producer like Maruti Suzuki producing cars, manufacturing cars for its own, meant for self-consumption, they are not included in national income. It is because the value of such services cannot be estimated, and services provided by your mothers at your places is one of the example. We simply cannot estimate the value of those services rendered by the housewives to their families. Next point, imputed rent on owner occupied house. Simply, I am living in my house. This house belongs to me. Therefore, I am paying no rent. But actually this house provides me fresh services every day, and the value of those services shall be included in national income. Last but not the least, value added by the government is equal to compensation of employees. That means whatever wages and salaries are being given to government employees is equal to value added by the government sector. It is because government does not work for profits, and the estimation of rent and interest for the government is not available. Therefore, we only consider compensation of employees by the government to its employees in order to calculate value added through value added method.